Hello students, welcome to the online classes of Cerebral Institute. This video on Basics of Accounting Part 1 is brought to you by Cerebral Institute Sparking Imaginative Learning. So let us discuss first of all what is accounting. This video is based on your accounting system, the principle of your accounting. So first of all we need to discuss that what is actually accounting, right? So, in simple language, we all say accounting is a record of all financial transactions and information which is very important for our business. In typical language, the definition of accounting is it is a systematic process of identifying, recording, measuring, classifying, verifying, summarizing, interpreting, and communicating financial information. It also reveals the profit or loss for a given period and value or nature of the firm's assets, liabilities, and owner's equity. Now the question arises that why accounting is needed? Why in today's modern era every company or every firm is using this accounting principles for maintaining their records? Why? Because accounting is a double entry system. Double entry system means accounting is based on debit and credit sides. See, all transaction in the modern accounting system has a debit side as well as a credit side. So, a complete transaction having debit or credit side is recorded in the books of accounts. So, that's why this is called a double entry system, right? There's a difference between bookkeeping and accounting. The difference is what in bookkeeping there is single entry system. There is no any debit or credit side, but in accounting system we use double entry system, and double entry system makes our accounting system more accurate, more reliable, and the accounting system accounting information is very useful for the owners of the business, because owner of the business has the right to to see what is happening in the business or where your assets and liabilities lies, right? So simply accounting is the double entry system. Double entry means debit and credit sides. It is very useful, reliable, and accurate one. I hope you all are getting what I am saying, right? Okay, let's move on. Next, we'll discuss some important terms which we use in our accounting system. First of all, there is transaction. Transaction is simply buying and selling of anything. If we are buying something, if we are selling something, this will be regarded as a transaction. Capital. Capital is the amount by which we start our business. It can be your cash or it can be in kind. Assets. Assets are the properties of the business. Liabilities. Liabilities are the debts of the company. Company is liable to pay their liabilities as soon as possible for the betterment of the firm or business. Debit, debtor. Debit is the side where your transaction is being recorded. Debtor is a person who is liable to pay us, like a person from which the company is liable to receive the money. Next is credit and creditor. Credit is a side in which the transaction is being recorded. Creditor is a person to whom the firm is liable to pay the money, right? Stock. Stock is the inventory of the business. Discount. Discount, I hope you all are knowing what is discount, because in daily life we all receive discounts from different firms or different shops. So this discount is simply the amount we save, right? Profit, loss. Profit and loss. Profit is your income by end of the year, and loss is your expenses or whatever you say, right? So at the end of the business, at the end of the year, we see whether our company is having profit or losses. Next is accounting year. Accounting year is what? Accounting year is a year for which the company made all these accounting books. right? In modern era, the accounting year is starts from April and it ends in March. So April to March is your accounting year. All the company uses April to March as their accounting year. The book of accounts are prepared for a year only. After a year is ended, your books of accounts will, you will made new books of accounts, right, for each year. Sale, purchase. Sale, if you are selling something to the customer, that is regarded as your sale. Purchase, if you are purchasing or buying something from somewhere, that will be regarded as your purchase. Drawings. Drawings is the amount which owner withdraws from the business for his or her private or personal use. We'll discuss all these things in few minutes. Expenses. Expenses are the cost of the company. Income, revenue. Income is, of course, the money you receive from somewhere. It is your income. Revenue. Revenue is earned by your sales. Balance sheet. Balance sheet is the summary of all your assets and liabilities. If your assets are matching your liabilities, like if the total of assets is equal to your total of liabilities, then your accounting books are accurate. If there is any deficiency between your total of your assets and liabilities, then your accounting books are not accurate. Bills receivables, bills payable. Bills receivables are the bills which you have to receive from your customers. Bills receivables are your assets. Bills payable, the bills you are liable to pay to someone. Bills payables are your liabilities. Purchase return, sales return. Purchase return is what? Purchase return is like if you purchased something from suppose mixed you have purchased something from Mr. X, right? And if after some time you return that goods to Mr. X, that then for you this will regard as your purchase return. Purchase return is always recorded in your credit side because because something is going out for your business. On the other hand, sale return is when somebody has purchased from you and he returns your goods to yourself, then this will regard as your sale return, right? And sale return is your loss and it is always recorded in the debit side of your journal entry. I hope you all getting my point, right? Okay, let's move on. So we'll discuss all these important terms one by one. Transaction, as I already told you, transaction is simply buying or selling of the of something, right? You are buying or you are selling. But let us discuss about transaction in detail. Transaction is of two types. One is complete transaction, second is incomplete transaction. In your books of accounts, only and only complete transactions are recorded. Complete transaction are the transaction in which all the parties should return something. Yeah, they should get something in return. Like if I say, Mr. X, you purchase something from Mr. X, say for rupees 25 you purchased a pencil from Mr. X. Okay? Now, you are purchasing your pencil from Mr. X, that means you are getting a pencil in return. And in return, Mr. X is getting money, right? So here, both the parties are getting something in return. That means there is proper consideration. There is proper consideration in this transaction. So here you can say that this is a complete transaction. Why? Because both the parties are getting something in return. Mr. X is getting your 25 rupees and you are getting pencil. Suppose if Mr. X gift you a pencil. That means he is not getting something in return. So if he gift you a pencil, this will not regard as a complete transaction. So only complete transactions are being recorded in the books of account. I hope you are getting what I am saying. Okay, now is your capital. Capital is what? It is the amount from which a proprietor or an owner start its business. Suppose if I say Mr. X started business for rupees 1 lakh and with furniture. Mr. X is starting its business by using cash 1 lakh and furniture. So 1 lakh rupees cash and furniture, these both things are your capital. So capital can be in your cash or can be in your assets, right? So simple, in simple language, capital is the amount from which we start our business. I hope you all are understanding. Okay, let's take next important term. It is assets. Assets are the properties of business. For example, your land and building, plant and machinery, cash, furniture, your debtors, stock, all these things are the properties of the business. Right? Types of the assets are tangible assets. Tangible assets are the assets which can be seen, which can be touched. Okay? Tangible assets will include your land and building. Why? Because you can see the land, you can touch the building. Your cash, right? You can see and you can touch your cash. So all the assets which you can see or you can touch are your tangible assets. Next is your intangible assets. Intangible assets are opposite of your tangible assets. Like intangible assets are those assets which cannot be seen, which cannot be touched, but we can feel that, right? We can feel the assets. For example, goodwill. Your goodwill, your reputation, your patent rights. You cannot touch your goodwill, you cannot see your goodwill, but you can feel the goodwill in the market, right? Current assets are the assets which can be convertible into cash within a year. ठीक है? It include your cash, your liquid assets, and etc. Fixed assets are long-term assets which you can use for long term, like your land and building, your plant and machinery. These all are your fixed assets, long-term assets. Fictitious assets are the assets which do not have any market value, right? And in accounts we will use fictitious assets very in very small amount. Fictitious assets can be ignored, right? So tangible assets is what? Seen or touched, right? Intangible assets cannot be touched. But you can feel it, right? Your current assets which can be converted into cash, right? Fixed assets, long-term assets. And your fictitious assets, no market value. Okay, let's move on. Next is your liabilities. Liabilities are the debts of the business, the amount which you are liable to pay, the amount which company is liable to pay to the creditors or to the outsiders. Liabilities include your current liabilities. Current liabilities are the liabilities which you have to pay during a year, within the period of 1 year. Long term liabilities, you can pay your liabilities for 3 to 5 years or more than 5 years. You have sufficient time. In long term liabilities you can pay your liabilities slowly, but in your current assets you have to pay your liabilities within a period of 1 year. Then is your contingent liabilities. Contingent liabilities are the liabilities, uh, like you can say, this type of liability is very rare, right? This is, you can say that contingent liabilities are the emergency liabilities. We don't have any idea, but they occur in a very quick way. These are very, these are considered as the emergency liabilities, and in emergency you have to pay the money to the required party. Okay, let's move on. Next we have debtor and creditor. Debtor is what? A person who is liable to pay money to business. That means business is in the safe side. Your debtors are considered as your assets. Why? Because if you are selling your goods, for a specified period of time, your debtors promises to pay the money within a specified time. Like, after a specified time you will receive your money. So debtors are your assets, right? So debtors are the person who are liable to pay the debts of the company. Creditor. Creditor is a person to whom business is liable to pay. So creditors are liabilities, and we have to pay money to the creditors first of all. Suppose if our company is having losses, right? Even in the losses, the company is liable to pay the funds of the creditors. Why? Because it's a liability, and we have to pay the liability of the creditors as soon as possible for the betterment of the company. I hope you all are getting what I'm saying. Let's see. Let's move on. Your stock. Your stock, as I already told, are your inventory. Stock is used as a raw material, and we can use our raw material for manufacturing our finished goods. So stock is an asset. There is no doubt about it. Stock is a very important part of our company. Without stock we cannot start our business, right? If I say that finance is the heartbeat of the company, so I have to say that stock is the heart of the company, right? Okay, let's move on. Discount. Discount, the money saved. We all know what discount is. Discount received, discount allowed. Discount received is what? The money we receive from the discount, as a discount from our from where we purchase something. If we get some discount, that will be recorded as your discount received, and discount received is your income, and it is always recorded in the credit side of the journal. And discount allowed here means that we are giving discount to our customers, and if we are giving discount to our customers, that means here discount is our loss, and we record discount allowed in your debit side of the journal. Let's move on. Next is your drawings. Drawings is what? It is the amount withdrawn by the proprietor or by the owner of the business for private use. Private means personal use. See, we all know that the property of the business is different from your personal business. Business can use the personal property of your owner, but owner is not authorized to use the property of the business, because there is a rule in your accounting that the business property is different from your personal property. You cannot use your business property or your business funds for your personal motives. If you use, you have to pay the interest on drawings. So interest on drawings is the amount which company receives from the owner. Why? Because the owner has used the funds of the business for his personal use. And in this case, company is liable to receive the interest for what he or she has given to the proprietor. So interest on drawings is the income for the business. Interest on drawing is the income of the business. And interest on drawing is always credited and drawings is always debited. I hope drawings is clear to you. Thank you for watching the online class of Cerebral Institute. Have a nice day.